Hey everyone, this is Kirk here again at optionalpha.com, and welcome back to the video recap that we do here each night on the membership side of our blog. So what we're going to do tonight is go over the opening trades as well as the one closing trade that we had here today on March 20th. And I want to spend a lot of time in this video actually on the strangle trade that we had for Nike after or right before its earnings that happened after the bell. So I got a ton of emails about this, and we don't do strangles too often because we don't usually find implied volatility as high as it was in Nike today. But I want to go over that one in detail, and then we'll cover it again tomorrow night in another video update after we get some movement in Nike tomorrow and see what happens to premium. So this is going to be a two-part kind of video on Nike and strangles and trading these around earnings and everything that goes with it. So we'll do whatever we can tonight, not knowing where the stock is going to open tomorrow, and make adjustments throughout the day if we need to, close it out, etc. And then come back tomorrow night and take a look at this whole thing all over again. And so you guys have a clear understanding of what we're looking at with the strangle and what we're looking at tomorrow when we get live pricing. So before I do that though, I want to cover the SLV trade that we closed out today. This is a really good trade, and you can see my highlighter tool just started working. But this is a really good trade because we closed out a debit put spread in SLV. Now, a lot of the ETFs for SLV and GLD and USO, a lot of these commodities have really been running kind of crazy over the last month and a half, and they've all started to come and turn around. And SLV is one that we put on not too long ago. It's just a couple weeks ago that we put on this debit put spread, and we anticipated that silver would go down and just kind of playing the downside of the market in that case. And today we closed out that trade and we sold back to the market our 22.19 put spread for a 2.15 credit. Now we took in a nice $55 profit on this one, and it was a really good profit, and I'm happy with it. And the question I got even after I closed out this trade was, Kirk, I think silver is going to continue to go down, so why not hold this position as silver continues to crash, right? Here's a chart of silver, and you can see it's just starting to really break and head much lower. But here's the reality, is that we traded a $3 wide spread, and we paid about mid-price for that spread. So we were actually trading with 50-50 odds when we began this trade. And so at that point, we have to ask ourselves, we're trading at 50-50 odds to begin with. Now we have a sure profit locked in. This is not a high probability trade. It was more of a directional trade. It was a low implied volatility trade. This is not the really good juicy trades that we like to make. So my opinion is you got to close out that trade early. You got to take that 50-50 original trade and make it a 100% winner by just closing it out. Now, silver can turn right back around, and all that the trade was saying in the beginning is that you have a 50-50 shot at expiration, which is in April. It doesn't mean that because it's heading lower now that it's going to continue to head lower all the way through April expiration. So you want to take that risk and leave the position on, by all means go ahead. But what we're going to do is we're going to close it out, and that's what's worked for us in the past. That's what's worked for us for years and years now. All right, let's get into some of the opening trades. We're going to start with Herbalife. Herbalife is one that we haven't traded since the latter half of last year. And we traded this one fairly heavily last year, but then kind of at the end of the year kind of fell off the map. It just didn't seem like it had any good trades. But then it's kind of come back on the market here. So Herbalife is another one. It's moving much, much lower. I got a lot of comments on this one as well. But we went ahead and sold the 50-45 put spread for a 145 credit. So this is a credit spread trade. I'll go to Herbalife. You'll see exactly where the shares are trading right now. So this is HLF. And you'll see that it's just had a huge, huge move down. Now, right now, this is partly news driven. There's all kinds of investigations and everything going in. But that doesn't mean that the shares are undervalued, that they can't pop back up. And it definitely doesn't mean that we can't continue to trade implied volatility, which is up near the 60th percentile. So implied volatility this high and shares that are trading this fast just begs us to at least put some money into this thing and make some sort of a directional trade, make an implied volatility trade. You can't shy away from things like this just because of news events and what ifs and scenarios and all that stuff. All of that information is already priced into the stock. So it will continue to move. It's likely going to be very volatile, but that also gives us a really good opportunity as traders to then make a profit on this thing. As always, keep your position size small. You can't get hurt even if it goes all the way against you. The next one that we traded was actually a recommendation from one of the members. So we sent out the alert on Herbalife, and somebody emailed me back and said, hey, Kirk, why don't you check out MNKD and take a look at that one and see if you are interested in trading that. So I do want to go through quickly the thought process on that because I haven't traded that. I don't think I've ever traded MNKD, at least the options. And so I want to go through the thought process of what I quickly looked at today to find out, hey, is this even a good stock to trade? Does it have good liquidity, right? We always talk about a stock that moves fairly frequently and that has good liquidity. And that's something that is really, really important because we want the price of those shares and the probabilities to be fairly based, right? A lot of people that are buying and selling and buying and selling makes those probabilities a lot more evenly spread and a lot more normal. So today we sold the 4-3. That's right, it's a very low price stock. So the 4 strike put, then we went ahead and bought the 3 strike put, and we took in a nice big credit of 37 cents. So this even moves our break-even period down, or break-even point down to around 360 or so. So that's really, really good for this. I'll go to the chart here so you guys can see exactly what it looks like. And you'll notice that it jumped up today here, but here's the real kicker. It's trading with 93 in the 93rd percentile for implied volatility. Now again, this is another one that's semi-news driven. It's a drug corporation, I believe. Something happened and they might get FDA approval, whatever the case is. Doesn't really matter. All we know is that implied volatility is high, and we sold the 4-3 options, which aren't even on this chart. They're all the way down below here, not even on this chart. I have to zoom out even further to get down to the strikes that we're at. So we gave ourselves a huge cushion, huge cushion in this thing. And if we're wrong, and it's a small trade anyway. But the fact of the matter is implied volatility that high allows you to move that far away from the market going forward. So if we actually go to the trade tab, you guys can see exactly what we looked for here. This is MNKD, and you'll notice that our position already in April expiration, the 4-3 right here. Now, 2 things I really look for when trading options. One, I'd like to see some good volume in the actual underlying. And you'll notice that both the underlying today had great volume and the bid-ask spread in the underlying was fairly tight. So it was about 2 pennies wide. That means that a lot of people are trading this thing, and right now it's just about a penny wide in after hours. So a lot of people are trading this. It gives us good implied volatility figures, and it gives us good probability figures for probability of in the money or out of the money, etc. Now, the second thing we look for is volume in the options. So you'll notice on the put side that the 2 strikes that we traded are actually 2 of the more heavily traded strikes. So there's almost 31,000 contracts of open interest in the 3 strikes and about 20,000 in the 4 strikes. You'll notice the 5 strikes have about 25,000. And then today there was a lot of volume in the actual individual strikes themselves, which is different from the open interest, but the actual volume today was actually quite high. So again, you get very tight bid-ask spreads. They've widened out a little bit here after the market closed, but these were pretty tight today. So that means that it's a very highly liquid thing. You can get in and out of it very quickly. I know a lot of people were in and out of this today. I know a lot of people emailed me and said, hey, that's a new trade. They like seeing that. It's something cool. So again, if you always have ideas, if it's something that you are trading, that we don't trade, that we usually look at on our watch list, as always, send it over. We always like to take a look at this. And this is just one that kind of fit the bill today. And within 10 minutes, we had a trade in the market here and working towards a profit. All right, so the last one I want to go over tonight is the strangle in Nike. So let's talk about the setup in Nike. We sold the 82.5 calls and the 77.5 puts. And you'll notice in the trade alert that the calls correspond with each other and the puts correspond with each other. So we sold the 82.5 call and the 77.5 put. Now this creates a strangle. It is a naked strangle, so this is a technically undefined risk. And I hate when people say that because there is defined risk. There is margin that you put up for this. For a 1-lot strangle with thinkorswim, and the margin account that I have is about $1,600 that you put up. So if you're trading an account and you don't have a level 2, 3, etc., whatever the broker level is in your particular platform, then you might have seen margin go even higher. Or if you're trading an IRA or a retirement account, you obviously would have had to have a cash secured and may not even make this trade. But if you're trading a margin account and a regular account, at least with thinkorswim, the margin on this trade was about $1,600. So not too bad. It does take up a big chunk of cash. We obviously don't want to trade that much, so that we only did a 1-lot with this strangle just to be conservative and not overextend our margin. But by trading and selling both of these options, the 82.5 and the 77.5, we took in a nice big credit of $2.60. So it was a nice credit that also helps widen out our strikes, which I'll show you here in a second. Now, what was the setup in Nike? Let's go to the chart of Nike so you guys can take a look at this today. Nike had earnings right after the close today and is trading pretty much all over the place. But you'll notice that today, implied volatility in Nike is at the 73rd percentile. Now, you'll have to keep this in mind when you come back to video 2 tomorrow. And again, we don't know where Nike's going to open up. I have no idea where implied volatility is going to open up, but I can take a pretty good guess that implied volatility is going to be dramatically lower, and Nike will be all over the map tomorrow. It will be kind of trading high, trading low, whatever the case is. Wherever it opens, it'll be all over the map. But one thing I know is that implied volatility will likely be down, and that's because we've already had this earnings event. So the anticipation coming up to earnings and the buildup in the stock, and you'll notice that the stock just kind of traded sideways for the last 2.5 weeks, just trying to figure out where earnings is going to send it. All of that's going to be over, and we're going to have more of a clear direction, at least for the next quarter, on where Nike might go, right? So that's the buildup to this. So we decided, because implied volatility is really, really high, up in the 73rd percentile, that we sold the Strangle, and so again, the 77.5 and the 82.5 call spread, and we made our Strangle very, very even on both sides. So we were about even on the call side and about even on the put side, just making this a very neutral trade. We wanted Nike to trade in between this tomorrow, and obviously want implied volatility to drop. So let's talk about where those strikes are positioned, right? Let's first go to the trade grid so you guys can take a look at this. And here it is right here, our positions in April. And you'll notice that our positions are right here, and it's trading a little bit in the money now because of just the after hours trading of Nike. But that's okay. We'll take a look at that at the break-even prices. But today you'll see that we were kind of right around the $80 mark, and that's exactly where Nike was closing. It was closing at $78.27. So the closest strike to that is $80, and that's where we put either end of our trade. So you'll notice that the put side was just below that, and you'll notice that the call side was just above that. And that combination created that $2.60 credit that now, again, moves our break-even points even further than the strikes that we have here. So if we go to the Analyze tab, you guys can see exactly where Nike's trading right now. This is our profit-loss diagram, and we have videos that go over profit-loss diagram inside the membership area. But generally, the profit-loss diagram for the Strangle looks kind of like an upside-down mound. And where the profit-loss diagram pivots, those are our strike prices. So you'll notice on the top side that our strike price pivots at the 82.5 marker. And down here is the pricing. So you'll see 82 is the price here, 83 is here, and 82.5 is right about there, and that's where the option on the top side pivots or turns down. Now we made some separation between us and the market, and again, the stock closed right around 79.29, and so on the bottom side, our strike at 77.5 pivots right about here. So again, down below where the price of the security is, here's 77, here's 78, 77.5 is kind of right in between here, and that's exactly where the stock pivots. But that's not where we start to lose money at expiration. What we have to do on either end for a Strangle is add or subtract the credit that we received. So on the bottom side, we're going to subtract $2.60 from our strike price of $77.50. That puts our break-even point down around $75, which is already designated on the chart here on Thinkorswim. On the top side, we're going to add $2.60 to our 82.5 call spread, or call side trade. So that puts our break-even price right around $85.70 or so. So that's exactly where it is on the Thinkorswim platform. Now, Nike right now in after hours trading is trading right in this range. And this is after earnings. So this is actually good, right? This is where we want. We want Nike to trade and open tomorrow in between our break-even prices, because we know that that's going to give us a good range between now and expiration to let some movement happen in Nike, but also see a contraction in volatility, which we should get a nice quick profit out of this. I'd say if Nike closes or opens anywhere tomorrow between about 77 and 82, we'll get a really, really good contraction in volatility, and the $2.60 premium that we originally entered will be down at least 50 cents or so. That's at least what I'm looking for, is a 50-cent move in that. And obviously we might take that profit right off the table in one day. So this is a really good example of setting up a Strangle right before earnings. Again, we have no idea where Nike's going to open up tomorrow. Right now, it's trading at about 77, and change, and that's where it's moving right now. So we'll see what happens tonight in after hours trading, and then tomorrow morning where Nike opens up. But again, be on the lookout. We're going to do part 2 of the Strangle and Nike so that you guys can see exactly what we did, and if Nike moves outside these bounds, if we make any trades or adjustments to the position going forward. So as always, I hope you guys really enjoy these videos. Please add your comments or questions right below. I'll get back to all of those tonight and tomorrow before the open, and happy trading.